Friday's monthly report on employment indicated that 20.5 million jobs were eliminated last month. The employment rate rocketed to 14.7% from a 50-year low of only 3.5% just 2 months ago. However, this apparently was not as bad as some expected, and the market took off. In fact, Wharton Professor Jeremy Siegel says unprecedented support for the economy now by the Federal Reserve and the U.S. government make it nearly impossible for the stock market to revert to its late March lows. Moreover, Siegel said he envisions equity markets rising well into 2021 and that he thinks 2021 could be a boom year. Understand that Siegel is talking mostly about the year 2021, but we're still in 2020. And even though we may not retest the lows, the road to the end of 2020 may still be tough. So let's take a look at the charts. And so we're looking at the 20-year monthly chart on the diamonds. The Spiders Dow Industrial Average ETF in the close on Friday was 243.62. Now, even though we're in the year 2020, doesn't mean I have 2020. So looking here, we can see the bottom at that point there, the top at that point here. Here we are at 243.62, about halfway in between. So that's a very good recovery. Now we bounced above the 50 EMA. We're still below the 20 EMA, and I think that's just fine. Moving down here into 2009 and just drawing a line up through here the best I can. Not very good, but you get the idea. We're still above that, and I think looking at that trend line, things are still performing pretty well. Here into the MAC. Now, the MAC is above zero. So that means there's still strength. Even though we've gone through all of the economic damage, we're still above zero. We're at a 3.139 with the slow line at 8.3. Now, there still is a pretty good separation between the fast line and the slow line, which means there is time for shenanigans, volatility, perhaps a small correction. I don't expect a retest, but we can have some aftershocks. Now, moving here into the histogram, you can see that we're at this level here. It looks like it's trying to start to turn, not quite, but we're about the level there as we were in 2009, so it's pretty serious. Moving on down here into the price rate of change, this does not look as bad as it did back in 2009, where we were well below that negative 50. We're up here within striking distance of that zero line. Now, it doesn't quite show a bottoming yet, but at least we have a little bit of a sawtoothing going on. I would expect more, and once we see more, perhaps that's going to start put in a better base. Into the RSI, you can see that bounce off there up to here, but we're having a little bit of a hesitation at this point here. So we got to see, is it going to be a hesitation like that and then we continue on, or is it going to come down and then head back up? Not quite sure at this point in time, but just be cautious and be prepared. Here into stochastics, it looks like we're trying to turn and turn above that 50-year midline, showing good strength. We're well above where we were in 2008, 2009, so definitely improvement there. Same thing for the Williams. We had that bounce down here into that oversold territory, but it bounced out pretty quickly above that midline or 50 line. So that is good too. So some of these oscillators are looking pretty favorable. Back on up here into the price chart. So the last thing that I'm a little bit cautious about is that VIX, or the fear factor, and we've talked about that in a couple of videos over the last couple of weeks or so. The VIX is just under a level of 30, just went under 30 today. So that is still double of a normal level of around 15. So there's plenty of room for volatility and perhaps a correction. So that's what I want to see dissipate. I want to see that VIX continue to calm down below 20 and into the teens. But until it does that, I'm going to remain on guard, and so should you. So be cautious and be patient and be prudent. And for today, that's ChewDog Charts. Thank you.